Yields for U.S. government debt turned mostly lower Friday after data showed U.S. consumer sentiment slumping to a fresh decade low and the Federal Reserve's preferred inflation gauge leaping 5.8% in 2021 to a 40-year high. What are yields doing? The 10-year Treasury note TMUBMUST 10Y, 1.789% yields 1.789%, down from 1.807% at 3 p.m. Eastern Time on Thursday. Yields for debt rise as prices fall and vice versa. The 2-year Treasury note TMUBMUST 02Y, 1.180% yields 1.168%, down from 1.190% a day ago. The 30-year Treasury bond rate TMUBMUST 30Y, 2.084% was at 2.09%, unchanged since Thursday afternoon. What's driving the market? Treasury yields from 1 to 20 years out slipped in afternoon trading, though the 30-year rate was unchanged, as economic data capped a volatile week highlighted by a hawkish Federal Reserve. The University of Michigan's gauge of consumer sentiment fell to a final January reading of 67.2, down from an initial reading of 68.8 and well below December's number of 70.6. Friday's figure represents the lowest level of consumer sentiment since November of 2011 and came as inflation concerns build. The Personal Consumption Expenditures Index of inflation soared 5.8% in 2021, the fastest pace since 1981. The surge in inflation is being underpinned by persistent shortages of supplies and labor. A narrower measure that omits volatile food and energy costs, known as the core PCE, rose by 0.5% in December, matching the 0.5% forecast seen by economists polled by the Wall Street Journal. For all of 2021, the increase in the core rate totaled 4.9%, compared to a mild 1.5% gain in the prior year. That's the highest annual level since 1982. The Fed views the PCE index, the core rate in particular, as the most accurate measure of U.S. inflation. Friday's drop in most yields follows Wednesday's policy update from the rate-setting Federal Open Market Committee, which pointed to the start of a steady increase to interest rates, which could begin as early as mid-March, as the central bank battles pricing pressures. B of A economists now see 725 basis point interest rate hikes this year, or one at each remaining Fed meeting. Investors have been attuned to the recent flattening of the Treasury yield curve, with the spread between 2- and 10-year rates shrinking to 61 basis points. On Friday, Minneapolis Fed President Neel Kashkari said the flatter curve is a sign that the Fed won't have to raise rates very high in order to get to a neutral level, in which the central bank's policy rate is not spurring growth or causing a contraction. What strategists are saying this past week, like much of the month, was dominated by an increasingly hawkish Fed, said Deutsche Bank strategist Karthik Nagalingam. Fed Chair Powell made some waves in his press conference when noting that this hiking cycle is already very different than the ones of the recent past due to a much stronger starting point for both the economy and labor market, along with much higher inflation. This means that this hiking cycle could look more similar to those of 40 years ago, in the 80s and 70s, Nagalingam wrote in a note. This increases the probability of back-to-back rate hikes, which is our new house view for this spring, and or possibly larger increment.